Well, overall, our base case is a soft landing, so that is the reason why we're modestly positive on equities, and also other factors are structural, such as the tech sector in the U.S., artificial intelligence. But at the same time, we understand that the market is a bit overbought. The technicals are not. It is very stretched at the moment, and also volatility is very low according to the VIX, almost I think the lowest since the pandemic, and valuations are arguably high as well. So I think these factors just restrain us from going more overweight in equities from here.
Yeah. I think the VIX is the world's most useless indicator of market direction. But as you quite rightly say, it's such an incredibly low level, a 12 handle as well. But there are other metrics out there, such as the skew on the downside protection or the single stock option volatility. Are they all pointing in the same direction, Janet?
Yeah, we believe so. I think overall the market has been trading in a pretty complacent way in a number of measures. I think primarily is because that there's this hope for rate cuts. There's this secular trend of artificial intelligence, and the earnings report has been great. So I think this has been supportive, and that's why we're modestly overweight. But at the same time, there are other measures such as the fact that I think for example, the U.S. economic surprises has been actually trending in a negative direction, and the market has been disconnected from that. I think that is a little bit worrying. So I do think there is a sense of complacency at the moment. I think we need to ease from these kind of overbought conditions before we can make further new highs.
Does that mean trim some of the gains in those large caps then? Does that mean we see that pullback, or is this just a case of a broadening? And when I say broadening, not necessarily pulling out of the big cap players, but really finding more winners?
The thing is, what happened yesterday prompted a lot of discussion of a rotation from the large mega cap tech stocks to the smaller caps. It is just a one-day phenomenon so far, so we'll have to see. But overall, I would say a broadening out in the stock market rally is a good thing, because a lot of concern is the concentration in the number of mega cap tech stocks driving the market. One of the things we're closely watching. So I think a broadening out is a good thing, and that is because markets expect the Fed to cut rate, and we can avoid a hard landing. I think ultimately this rotation, or this short rotation, or a broadening out in the rally is actually setting up the stage for a healthier, more sustainable equity rally in the longer term.
Janet, does broadening mean that you go into these small caps? I mean, seeing that Russell 2K yesterday have its best performance since November, up around 3.6%, 5% up this week, still only 5% up for the year.
Yeah, that's the thing. We're still pro the quality growth segment, so that you tend to find them in the mega cap tech stocks. The thing is, as I said, it was a one-day move yesterday, and it was pretty significant. So not sure how extended that rotation is going to run for. And I personally believe that yes, rate cuts will be helpful for small caps who has been struggling with higher financial cost and pressure. But at the same time, we know that this is likely to be a shallow rate cutting cycle. And also the fact that, as I said, economic data has been actually softening, right? Particularly in the labor market. So I think for small caps to really outperform sustainably, you need more rate cuts and also pretty robust economic data. And I don't think we're there yet. But we'll see. Maybe I'm wrong.
Yeah, I'm sure you're not, Janet. You know far more about these things than we do. Tell me about the United Kingdom. Rachel Reeves is a very smart woman, and Sir Keir Starmer, her boss, has just had an incredibly strong win. But they got lucky on the GDP data. They may get lucky on the first interest rate cut as well. They may even get lucky on this useless country actually winning a football tournament. I say that with jest. But the point of the matter is there is a tailwind behind them at the moment, even before they've really done anything as well. What does that mean for UK assets? I appreciate the FTSE 250 is up over the last year significantly, but it's roughly trading where it was at its peak under the Tories as well from May this year. the UK equities look good from a sentiment point of view all of a sudden?
I do have that sense. I do feel it. I think UK was one of the most hated markets for a long time since Brexit. And I think finally there's a sense people are actually finding UK appealing again on a number of measures, right? So our view is that yes, the UK came out of a recession. Things are looking better. If we're getting a soft landing, I think UK assets are quite cyclical, so that's helpful. But fundamentally, I think it is just cheap. It is trading at half the valuation of US equities. It's got some great companies in there paying high dividends. And for us, it is actually a cheap hedge against all the other growthy areas in your portfolio. I mean, as I said, we still like growth, in particular if inflation is slowing, rate cuts are coming, growth should do well. But at the same time, we saw things happening yesterday, the rotation and broadening out. You do want some value play in your portfolio. You do want diversification, and we think UK is a cheap way to provide you that diversification.